delighted to welcome back to the stage our presenters from earlier, and Jonathan Ramsey from Trellia Wealth Partners, powered by InvestSense. Jonathan has experience in small cap investing, consulting and research in his time with Van Eyck. He was educated in England with joint honours in French and economics. He's an associate of the Institute of Investment Management and Research and was a co-founder of the now Trellia business. Jonathan, what's your take on portfolios right now?
Well, when I first started looking at the presentations, I thought I was going to have to play a bit of devil's advocate because there is a lot that I sort of agree with there. But I think even looking at what's happened overnight, maybe we've got an opportunity here to sort of think about the sort of what if we're wrong questions, because the presentations were great, very short. We love a short presentation. There's a couple of my clients in the room that have just choked on their water there. I don't necessarily practice what I preach, but I think there was some broad brush things there that I basically agree with. And kind of what's coming to mind is, what if it's more complicated than that?
Let's get into it.
So, hi guys, well done. Thanks very much. Very succinct, I actually have the benefit of, I had a little birdie in the room at your last session, so I sort of heard a little bit about what went on there. And first of all, you seem to have synced yourselves with the Fed sort of circus at the moment, because I think when you were talking last time, Stephen Moran was confirmed, and that was a bit of a talking point. Yeah. Now that you've had not only a bit of time to digest that, and maybe I'll start with you, Kevin, but also what happened overnight, the reaction in markets was quite interesting in the way that people voted. Have you had any further thoughts on that issue around Fed independence and what the market seems to be taking from that?
Yes. So the Fed is not independent. So that stage is gone. And the period of central bank independence was very brief. I started my career working at the Bank of Japan 30 years ago. And that was when central banks were trying to become independent from the treasury function. But the Ministry of Finance in Japan, to remind us that we weren't independent, if you've ever looked on Japanese currency, it's got written down, printed out, Okurosho, the finance ministry in Japan. So we've had this experience with central bank independence, like we've had the experience with fiat currencies that aren't backed by gold since '71. That period's over. Fiat currencies working the way they work in central bank independence. So Stephen Moran, he was confirmed on Monday. So that means there are 3 governors, 3 out of 7, who are aligned with the Trump agenda.
Although, was it interesting how they voted? Do you think they were making a stand there?
Yes. So I think Chris Waller just lost the chairman job.
Yeah.
If you notice, there was one dissent, one didn't go 50 basis points. That was Steve Moran. It was a surprise that Chris Waller didn't vote that way. If he wanted the chair job, which will be up in May, that's what he should have done. And the other Trump supporter, she also just was happy with 25 basis points. So overall, I think the market was a bit disappointed. The market wanted a more dovish, a more change message. And I think the other theme in this is that we've had mission creep from central banks. Central banks are supposed to be about cutting and hiking rates, taking away the punch bowl when the party gets to be too much fun. But they've got into bank supervision. They've got into US dollar swaps in case there's a financial crisis. Some of them got into ESG initiatives. It's really not clear why central banks should be doing this. Yeah. And a lot of these things should be part of the treasury function, not an independent central bank.
Marc-André, anything to add to that? But also, given that you've got some quite clear and specific views on the US dollar, over the next 18 months or so, has that shifted? And I think because the market kind of went one way and then went the other way very quickly, it seems confused.
Yeah, so I think, overall, the market reaction today was relatively muted, right? So for a Fed day, right? I think that's helped from the fact that over the last, call it few months, right? And amplified in the last few weeks, there's been more and more data that at least a central bank, let's assume independent central bank could anchor on to justify a rate cut. So essentially, if you've got people that have a political agenda to cut rates, then you've got like a bit more alignment from the economic data. So that the clash is not as great, right? So I think 12 to 18 months, where we're going to have like bigger questions and concerns is at some point you could assume that inflation might end up being stickier or stay or even raise from here. And at that point, you're going to start to get a clash between what economic data would lead monetary policy to do and what I would assume the Trump administration will want to continue to see. And that divergence then is going to be more problematic to digest for markets. Yeah. I think, I mean, lower rates than would be needed are short-term gains for probably long-term pain, right? Mm-hmm. And I think that's kind of the environment we're going to run into. Yeah. Yeah. So for the time being, it's good.
Yeah. So is there a version? So maybe I'll get into and I'll maybe get some comment on emerging markets and the bond markets more widely in a minute. But I guess that sort of medium-term view of it sort of getting slightly stagflationary, there's a solid sort of basis for that. However, when you look back at what's happened over the last 3 months, we've been surprised. Flows have gone, people have front-ended the tariffs. Capital and trade flows into the US have actually increased. Mm-hmm. And that no one was really predicting that, or not for it to sort of go for so long, at least. Does that mean that and sorry, I will come back to you, Alec, in a minute. I know this is not completely your wheelhouse quite yet. So maybe stick with you, Marc-André, just for a minute. What are the other theses around that, the risks that we listen to you, we say, yep, that's a thesis, it's a rotational, stagflationary, ex-US world, and then something else happens that surprises us, because there's a little bit of consensus creeping in there, maybe.
Yeah, for sure.
And I guess what I'm alluding to is a deflationary recession,
yes.
And the US dollar strengthens, yields come down, etc.
So I think right now we're still in the period where there's been a lot of distortion in economic data coming from front running, and all that, right? So you get like a series of I would say whipsaws and data, right? So it's difficult to see where we land. It seems also that for now, the bulk of any tariffs that have been put in place have been taken by companies and not passed through to consumers. And if that keeps on, what is the extent, right? At which companies are going to be willing and able to do that. So I think that this probably is something we need to look for, and see where these things land. Tariffs in theory are a one-off event, right? So if you impose a tariff, prices go up, and then eventually the year after, year over year, that doesn't appear. The fear is always contagion for that, but if we get a significant slowdown, I wouldn't be surprised to see inflation be well behaved, in which case we have still 425 basis points of room to cut rates in the US, and that's very, very significant.
Mm. Yep. Mm. So just sticking, maybe we've sort of gone into the tariff situation. Alec, given that thesis that you put forward, there is still a dependence in emerging markets. They're still export-driven economies. And in a tariff-driven world where we've had this front-ending, but suddenly, you have this vacuum, is that something that threatens your thesis to some extent? Or emerging markets much more independent and resilient and less dependent on US trade flows?
Well, it's tough to make emerging markets a full monolith, but if we just use Mexico as an example, they're the big winner of the trade war. Their effective tariff rate is 4%. So we think about who's bearing the brunt of this, particularly in the context around China really pursuing more of a weaker currency export strategy. It's supportive of EMs, particularly lastly in terms of this dollar debasement theme. Emerging markets, from a terms of trade perspective, numerous, you think about South America, parts of Africa, and the rise in gold prices is going to be a tailwind for countries like Peru, Ghana. There's ways to really play individual structural themes within emerging markets. And then, just to add on and maybe piggyback from the last question, to us, the risk is a deflationary recession. And if you dig into the Waller speeches over the last pre-Jackson Hole and post-Jackson Hole, the tell is there. Buried in the footnotes is the notion that the Fed thinks they have a better tracker of employment than the market has. They did a partnership with ADP. On a weekly basis, they get 20% of all employers giving them data. They think it's better calibrated than the GFC, and that's the core thesis for Waller. So if we think about what are some of the big risks out there that are underpriced, for all the discussion around Trump and Fed independence, if Waller's thesis that this is a deflationary slowdown, that tariffs are more of a consumption tax that are going to weigh on the broader economy, particularly given what's been seen from import prices, and the Stephen Moran paper very, very convictedly said that exporters are going to bear the burden. We're not seeing that. Mm-hmm. And emerging markets in that scenario that have far more room on the fiscal and monetary front. We've seen empirically this year that the dollar smile is not working out the same way. In that example, we think EM can outperform as well.
And you're also seeing increasing trade outside of the US between other parties, which I guess...
I think Kevin did a great job of really breaking out the capital flows from the trade deficit and thinking about what the redistribution of capital flows would mean.
Now, so forgive us if it gets a little bit specific to the Australian context, but I don't think this is unfair because it seems like you've been around the traps and talked to clients and they've asked you this question. So maybe you can reflect those conversations here. And it's about hedging. And as you pointed out, Kevin, that is, not only do we live in a world in a country that has quite a cyclical currency, quite volatile, but we've had these sort of 10-year periods. And as you said, the last 10 years, it kind of really worked out. People have got really used to that. You don't hedge, you get your Aussie dollars. So for our international exposure, it's the easiest way for us to cut, the easiest lever to pull is to hedge global equities, which is a sort of blunt tool, or do it within the US. Yep. So if I put up a sort of stalking horse, for instance, say we've got 70% of our international exposure in US, and a sort of hedge ratio that sort of seems to be coming into view that people are using is hedging about half of that. Do you think that's the right number, or do you feel so strongly that actually you should hedge the whole lot? Or maybe Marc-André, when we get to you, how is there a timing element around that? But first of all, Kevin, what's your take on that?
First of all, don't time it.
Yep.
Because if you're trying to be tactical, you're competing with the big trading floors, and you're not going to win that.
Yeah.
So come up with some disciplined strategy and implement it. Every quarter, every half year, revisit and rethink it, but come up with a strategy. And there's no one size fits all. It's going to be different for every firm. I've been talking to a bunch of supers this week. They're very thoughtful. Previously, they've hedged a lot. They're not hedging a lot in terms of right now their equity exposure. They all want to be doing it. But you do lose the muscle memory if you haven't been doing this for over a decade.
Yep.
The traders and the specialists have moved on to other careers. So the advice we've been discussing is starting, maybe do 20%. So to figure out which instruments you want to use, how exactly you do it.
And single out the US, or?
Well, I think the big issue is the US dollar, right?
Okay.
So I think focused on the US, and typically that's, depending on the fund, say roughly 60%, maybe as high as 70% of the exposure. So maybe starting at 20, maybe with an eye to go to 50. Going to 100 is difficult because then you can end up being overhedged and actually hurts you. But right now, the cost of putting a hedge on is 50 basis points. A year from now, you're going to get paid to put the hedge on. We see a world in which there's a lot of FX volatility. You're not going to get compensated for that risk. So it strikes me, it's hard to come up with counter arguments for having those discussions now and dipping your toes in and starting to put the hedges on.
Yeah, can add to that. I mean, it's a question that is super important for us also as Canadian because the currency behavior obviously is extremely similar. I was a risk officer for one of the big pension funds post GFC, so all of these things I've spent a lot of time thinking about. I would not disagree with anything Kevin has said. The one thing I would say is that if you hedge on a substantial portion of your portfolio, you need to think about what this implies for rebalancing and what this implies for liquidity risk, right? So if you, for example, want to hedge a less liquid portion of your portfolio, a high yield exposure, then it's a different game because the Canadian dollar and the Australian dollar have historically depreciated massively over a very short period of time, and that can be a big liquidity drain when it comes to liquid, like margin calls and so on and so forth. So I would say that's the one thing that has gotten some investors in trouble in 2008 and 9 and 19, 20 is structurally when you implement hedges on a big portion of your portfolio, be very wary about the impact it has on your total portfolio behavior.
Yeah. Do you anything to add there? And maybe if you wanted to add something on emerging markets, and I know it's maybe more within equities, but maybe if you could allude to the reflexivity that can come in, that we know what should happen for the fundamentals, but traders have a reaction function, and with emerging markets in particular, and I think maybe the Aussie dollar at the moment, there's a little bit of that going on.
It speaks to the notion around tactical versus structural positions and how one sizes the individual asset allocation, where it fits in terms of a broader, assets liability for any allocator. So I would be, I'm personally a little bit hesitant to say the exact number, but if you think about Argentina in 2018, 2019, it's a classic example of a crowded trade, lots of flows into the asset class, and what can happen in an unwind.
Yeah.
I mean, that is a major part of the story in 2019 was post the IMF meetings. People came back and realized they all had the same trade on. The door was pretty small. So a big part of emerging markets and being thoughtful around a more tactical allocation is what is the liquidity profile, how crowded is the trade, what's the exit liquidity, and so for us, we're mindful, as one always should be within portfolios. What are the risks? And it's inherently. It is very challenging to transform illiquid risk to liquid risk. So we're always mindful of that.
Look, just in the few minutes that we've got, if each of you in turn, I think we've sort of talked about it a little bit, but there is a theme here, end of US exceptionalism to some extent, which has sort of been going in and out of favor. And by the way, well done, Damien. You seem to have, over 10 years, curated a bunch of, I was going to say US, but North American managers who believe apparently quite strongly in this. That's quite contrarian. And maybe build into that, because the big levers are tech, US, ex-US. I think you've all voiced at various points that tech is a part, it's there, it's fundamental, but is it too expensive? Do we, when we move out of the US, because I'm going to assume that's your that's your prognosis, do we also leave money on the table with tech? Just because it's too volatile, for instance, or do we have to bifurcate these things? Do we have to sort of treat them separately? And then maybe to finish off, I know it's a very long question, but what are the other opportunities? What do they look like? Where do we get 10% nominal or 5, 6, 7% real returns over the next 3 to 10 years? Marc-André.
Yeah, I can start. I would say I would be careful about when we talk about tech and we put it into U.S. exceptionalism. I think that's a very difficult word to say. I say it well in French, but I would say that's a danger. I would say there's a tech exceptionalism, right? So in a sense, I think, and also, I mean, a company like Google might be listed. It's not because companies are listed in the U.S. that their headquarters in the U.S. that those companies are global, right? So I would carve them out. I would say I would agree. I think that when I think about the U.S. situation, I think what is happening is there's a breach of trust on multiple fronts that is happening, right? So whether it's on what the government, the president's going to do, what on the military front, on the geopolitics front, and I think that has long-lasting consequences, right? So what's the great idea? I would say in terms of protecting your portfolio, I think credit is extremely tight. So if you want to protect, I think that's pretty asymmetric. So protection that involve like credit indices, I think are quite compelling. That's not going to do you 10, 15, but it might protect your portfolio quite good. When it comes to what's appealing, what do we see? I think EM debt, and I'm gonna support what Alex said. I think that's probably where we see, I would say, the best risk-adjusted returns prospects. Okay.
So U.S. exceptionalism, at least in tech, remains. So there's two places in the world where you can get access to AI innovation, and ultimately this is what's going to drive equity values and going to drive value creation broadly. It's California and it's China, and it's hard for investors to get a lot of this in China, but there are exceptions like CATL, BYD, and some of these companies which are involved in physical AI aspects. So you want to have exposure and you want it to be significant. And over periods of 5 to 10 years, you're going to get 8 to 10% returns, whatever that number is going to be. And so we look now and we see how stretched valuations are in public markets with Palantir, Tesla, Oracle, and so on. If you look in private markets, it is totally nutty. And I think Sam Altman encapsulated this well, where he said you can believe in two things. One is that AI is going to change the world, highly disruptive, create enormous value, and then short term, we have all sorts of unsustainable things going on. So how do you think about that? So if it wasn't for the Fed cutting and the dollar weakening and both Beijing and DC deregulating like crazy, I think markets would be wavering and waning right now. But we've got these tailwinds coming through, so it could last a little bit longer. And then you have to be smart to say, well, I know when the market's going to turn, and I know how much it's going to turn, for how long, and then when it's going to go back. So you have to be right here, you have to be right here, and then you have to be right in calibrating the government response. And if you're smart enough to do that, good for you, because you're a billionaire. That is really tough stuff. I invested through the tech crash 25 years ago. It was really hard. When you look back at the chart, you say, that must have been easy. You must have made so much money investing through it. No, it was not easy at all. So what we're doing is we're max overweight quality tech. And it's sort of the idea, this is a center of innovation, value created, and we want to be there. But still, given that, you want to be diversifying out of US equities, the US dollar, into global champions, where there's return invested capital, free cash flow generation, and the type of companies that Alec's been talking about.
Alec, I've got a feeling that you know a place where you can find 10% returns and less volatility. Yeah. Make the case for that, and perhaps anything else that you think is relevant.
Now, sitting here as the public fixed income person, the role public fixed income, liquid public fixed income should play in the portfolio comes down to two things: diversification and income. There's going to be many other speakers here who have upside cases where you can find price return, and I would harken back to the chart that shows fixed income is a negative price return asset class. Now, while there may be opportunities, within EM, local rates in particular have South Africa, Mexico, Brazil, real rates in the 4 to 6% context. I'm not sure if I'm right or wrong on emerging markets, but I feel highly confident that in 1 year, 5 years, 10 years, I could look back at anyone in this crowd and say, income and diversification worked. So there's one message as the public fixed income guy. Those two things will work in portfolios over the medium and long term.
Okay, fair enough. Now, Ben, I think we've got another 5 minutes, but I've got flashing red lights. Go for it. Because we've got a few questions here. I wasn't actually checking my text. Yeah, absolutely. That's the one I was going to go to first of all. Gold, difficult to avoid at the moment, and people are either kind of trimming or happy that they were there, and also increasingly skeptics getting on board, which is always a worrying sign. Marc-André, do you have a view on gold, and should you be trimming? Should you be adding? Should you be initiating if you didn't own it?
Yeah, I think, if you think about what are the risks right now and what we've been discussing for the last half hour, if you believe strategically there's still a story about US dollar debasement, then I think the story for gold is still there. Is it going to be a straight line? No. Are there going to be pockets where positioning is too tilted? Yes, right? And that might be one of those periods right now, but I think that the story is still there. If you think about what happens if a central bank is forced to keep rates too low for too long? That's, inflation and sticky inflation, and that's probably also another reason why gold makes sense. So I would say the medium to long-term story is still there. There's going to be It's not going to be, none of these things are straight
Yeah.
lines. Yeah.
Stay long. Yep.
So Warren Buffett uses a four-letter word to describe gold, and he's not a dummy. Keynes calls gold an archaic relic, and Keynes certainly wasn't a dummy. But in the world we are today, where we're thinking about inflation hedges, we're worried about debasement, not of the dollar, but of the US dollar-based global financial system, you have to be thinking about alternatives. In the fiat currency world, the alternatives aren't great, so we need to be thinking about commodity-based currencies, so gold and silver, and then ledger-based currencies, so Bitcoin and types of crypto. So I don't know how to trade gold, and I don't know if tactically you should be selling now and then buying back 3 months from now. But I would think there's fundamental reasons that gold has
Keep
a
it in
dip,
your portfolio.
and this will continue.
Alec, anything to add to that?
It's another asset class that's structurally underowned by allocators. In thinking about the Trump administration, if forced to protect the bond market, the equity market, or the U.S. dollar, the U.S. dollar is going to be the least painful to reduce purchasing power for many U.S. consumers that their assets are in U.S. dollars, their income is in U.S. dollars, and their liabilities are in U.S. dollars.
Okay.
So I think it's another way that investors should look to diversify some of their exposure.
Okay, so we're short US ex-tech at least, long gold. Emerging markets, you alluded to that, Alec, before. It's a broad church, and that can mean two things. It can mean that there's enough diversification internally that you can just go there, or it can mean that there's a lot of different things going on, and you want some of them and not the others. Emerging markets, I'm kind of guessing you're probably going to be for. And maybe, from an allocation point of view, we're probably thinking about equities more, given the choices the audience can make, as well as investing in your product. Which of those two? Is it more emerging markets, or do you have to be very specific about what you own? And I guess you're going to have to bring China there and governance risks.
To us, it's more the latter.
Yep.
On the EMD side, we look at 8 different countries. We typically own around 15 to 20, but by and large, emerging markets have a very different default distribution profile. It's more rolling defaults rather than U.S. credit that has had 3 major default cycles over the last 35 years. Diversification around whether it's regionally, quality, importer, exporter, tourism is certainly beneficial, but at times there's always the risk of being overly diversified. And one has to be mindful within emerging markets, what type of volatility can one hold through?
Yeah. Yep.
On the China side, it's less of a focus for us. It's more of an equity story. But from an index construction standpoint, our view is a lot of EM equity strategies, indices at large, over-indexed to China, Taiwan, even Korea. So looking for ways in which to have a more diversified EM, equity exposure, more LATAM, more rest of the world, and not say you're...
just where the issuance is.
Yeah.
Yeah, absolutely. Kevin?
I was going to start mentioning, when we were talking about gold, the key buyer of gold the last year or so, it's been central banks, Asian central banks in particular, and I think this is going to continue to be a nice tailwind. In our internal discussions with us allocation, also when we discuss with clients, I think people are sort of agreeing on the top-down story that it makes sense to be allocating more to EM. So then you need to talk to your bottom-up stock pickers and what you buy. And so we look at China, and we can find, say, 6 names that look really interesting to us with good return on invested capital, free cash flow. We can't buy 50. Similarly, when we look at India, Turkey, Brazil, and so on. So there's this tension between the top-down story, which looks pretty compelling, and the ability to find global champions which fit our investment philosophy.
So what rises to the top there? Is it China tech or?
Well, 2 names in particular in China. CATL makes 40% of the world's batteries, fantastic innovation. And clearly everything in the world with physical AI is going to be run by batteries, and CATL will be a crucial part. And then BYD, and it's nice to see BYD products everywhere here because we don't have those in the States. And so the price points for BYD is pretty nice. And both companies now have a return on invested capital significantly above their WACC.
So there's a bit of a theme there.
Yeah.
And then Latin America, India, from a bottom-up perspective, do you find them less prospective or relatively so? Which one?
Yeah, I think there's individual names in, say, Turkey, India, and Brazil that look very interesting. In India, there's still valuation challenges. But you can identify like half a dozen names. You can't, it's difficult for us to find 20 with the liquidity.
But beware of India. And very quickly, because I've led us astray and gone over line, and I really am getting red. But I think you've got a minute or so, thanks.
Yeah, so I think just related to what we've discussed, whether it's US, whether it's EM markets, or whether we're going to talk about private markets, I'm going to be back again. I think all of this highlights, I think, the need to go 1 degree lower. So I think this notion of like, oh, let's just make asset allocation choices at the very broad level, I think you start to see the weakness of that because there's been more polarization in these asset classes and differences and siloing. So I think it's time to go 1 level lower.
That's exactly what it's time for, which is what we're about to do, is go 1 level lower. So well played there. Ladies and gentlemen, Jonathan and the panel, thank you very much.